Thank you, and good morning, everyone. For us, this report on the SaaS sector has been now we've been doing it for 3 years. It's a special sort of initiative and effort that we are putting in. Overall idea and the objective has always been that SaaS ecosystem in India always felt like there's a large potential, and there are many things which the founders who have been pioneers in the industry have learned along the way, which sort of, the report is a attempt to capsulate and summarize the learnings of different sort of founder communities and also ourselves as investors. What do we see as some of the sort of focus areas every year when we sort of look at this report? The idea is that that can potentially help the aspiring entrepreneurs and the entrepreneurs at different stages of the company building to learn from the playbooks that have been successful for some of the other entrepreneurs, and also sort of sets the tone for what can potentially be the new areas that are emerging in the SaaS ecosystem. Equally, learn from the global markets where the SaaS has been a lot more mature, and learn from there to understand how do we go about building the companies from India. So that's the overall objective.
And Sudhi, just adding to what Venkatesh shared, and good morning, everyone. I think, as a country, India's got a lot to offer to the world. We as Indians would be believers, but the global ecosystem has also been believing in India's potential. This report and the fact that we have been doing this over the years is a very serious attempt to make sure that there is a consolidated narrative in terms of what's happening in the ecosystem, and people have an unbiased view in terms of what's really happening on the ground and how to sort of understand and how to take actions from there, how to take decisions, and consequently build great companies. A very big shout out to Chiratae Ventures and the team. They have been always an excellent partners, bringing a lot of real world experience in terms of building companies, in terms of enabling entrepreneurs, and making sure that whatever we see and hear is also contextualized in terms of what's really happening behind the scenes. So pretty excited in terms of having the third edition of the report. Sa, thank you so much for the readout. And Venkatesh, to dive right into it, a lot of initial questions in the Q&A were in and around valuation, right? In terms of, are we really bottoming out? Is it really turning? Can you talk to us a bit more about, when we look at the public markets, how is the valuation scenario panning out there? And what is it that you're seeing on the private markets also? And we could maybe build from there.
Sure. Sure. So, overall, when you look at it from the valuation perspective, I think there is no question that there's been a huge correction from the the pandemic liquidity-driven valuation multiples. Like Saad was highlighting, there's a clear period where the multiples have actually grown on an average to about 15 to 16x at the overall SaaS level. There was a question on whether we're referring to this as a ARR or a next 12 months or the trailing 12 months revenue. We're all referring here to the trailing 12 months revenue. And that EV to trailing 12 months revenue, which is a good capture of how the valuations are sort of getting increased to almost an average to about like a 15x. There were a lot of factors that were driving that increase in positive sentiment, like Sad was saying. One, of course, there was a higher liquidity, which drove valuations across sectors. But it's more specifically on the SaaS side, in the post-pandemic era, with the advent of higher amount of digital adoption and the tech adoption, emphasis on sort of revamping the tech architectures, even in the old age industries, etc. There was a definite increase in demand in the growth rate of the SaaS companies. All of that sort of reflected in the valuation multiples, but the valuation multiples are clearly corrected from those averages of about 16x to, in the more recent past, to almost went to the 5+ sort of EV revenue multiples, right? It's almost a correction of 2/3
Right.
Uh, but in the more stable pre-pandemic 2019 era, the nice graph that Saj showed, it was hovering around 9.5x, right? And if you see in the more recent past, to answer your question, Atif, I think there is a clear stabilization of this, revenue multiples, both in the public and the private markets, and and there's been a increase, very gradual, very small at this point, but over the last couple of quarters, to where it is now sort of standing at like a 6.5x or so. And this we're also seeing for companies of different growth nature and the fundamental metrics. There is a different valuation. So top
Right.
quartile companies are definitely getting valued better,
Right.
even in the current markets. But if you look at the key takeaways, it does feel like we're in a market where from purely from a valuation perspective, there is a bottoming out, and that's also getting sort of reflected in the overall funding activity, where it also feels like there are green shoots of potential increase in momentum. But all of this we expect based on the current sentiments for it to be a lot more gradual. And even when we refer to, and even when Saad refer to the recovery, I think we are essentially referring to the recovery to pre-pandemic levels, right? And not necessarily the 2021 crazy valuation multiples. I think, based on what it does look like, potentially over the next 12 to 18 months, we should be expecting the both in terms of the momentum of the deal activity and also the valuation ranges potentially could be in the pre-pandemic levels in the next 20.
Got it. I think that's a good call out, Venkatesh. And for the audience also, one of the things which came out, through all the interviews and surveys was that the ecosystem at large is, keeping the pre-pandemic levels as a reference point in terms of solving for or going back to. Everybody for, I think to be cautious or to be smart, whatever you may say, but I think in a very good way, it's not even trying to, target the pandemic multiples right now. It's been seen as a boon which comes in. And to your point, I think it's very true. The top quartile, companies on the public listed markets have already come to pre-pandemic levels, which is there. Could you shed a bit more light in terms of what is that difference, broadly speaking, between what would be a top quartile firm and a bottom quartile firm in each SaaS talk about?
Yeah, so it is a culmination of multiple sort of factors, and a lot of these efficiency metrics are coming to the fore a lot more in the current markets than in the previous markets, where it was largely growth at all costs. But now you're looking at valuing the companies in a way where a lot of the efficiency scores and how efficiently the company is growing. So one of the very popular metrics on the SaaS side is to measure what we call as a rule of 40, where it also encapsulates the growth plus the EBITDA levels, whether it's negative, positive, the companies, where cumulatively, if it adds up to 40, considered as a good, healthy sort of company which is growing at a good rate, right? So clearly, the top quartile companies are the companies which are performing at very good efficiency levels, whether it's your spend, the marketing spends to the actual sort of in net new additional ARR that the company generates. So, the companies which are growing well but are growing really efficiently are how get categorized as the top quartile company. And there is a slide in the report which specifically talks about how some of those top quartile companies are doing on the efficiency side. And even during our conversations with the founders, it's very apparent, it's very evident when you speak to the founders that there are there is a sense of feeling very happy about the current situation. Also, of course, there is an element of valuation corrections and cash flow and the funding pressures, etc. But at the same time, it's also helping the founders sort of really put their head down and focus on those efficiency metrics, because
Right.
that is getting sort of appreciated in the valuation metrics that one is looking at, right? So top quartile companies really looking at key efficiency metrics while there is growth, and the companies which are growing well with really sort of good efficiency metrics to show are being categorized into the top quartile and are hence getting higher valuation multiples, even in the public markets where the averages are still today have improved to 6.5x. The top quartile companies are already sort of closer to 10x, right? So that improvement is much faster for the companies today where there is efficiency and you can demonstrate that the investor sentiment and the valuations that the companies are getting is much higher.
No, got it. I think the point you spoke about in terms of being able to focus on the business, such a great point. I remember 21 with all the funding coming in, and even early 22, there was this whole race for developers, and I think everyone is trying to outcompete in terms of who gives a bike and who gives 10 laptops or who gives a holiday. And nothing wrong in that, but sort of takes away from the core, right? So there's a silver lining there. Speaking of also, building on the efficiency part a bit, right, Venkatesh? Uh, the common questions which keep coming out is that, look, I can reduce the cost, but to what extent, right? And the philosophy, what I would call as a Lala philosophy, that you can't become a billionaire by saving monies, right? So how do you think about growth? So while the strategy appears to be in terms of growing into a better multiple and in terms of being efficient and also expanding your business, do you want to talk about any interventions or any first principles in terms of how founders might want to think about how they might want to approach in terms of moving from bottom quartile to say top quartile?
Sure. And there were also several questions in this regard in the Q&A sort of chat box. Just want to also try and address some of those things. So when we saying that the founder mindset is moved clearly towards building higher efficiency, and doesn't necessarily mean that you're going all berserk and cutting the cost left, right, and center. I think there is an element of bringing in clear sort of discipline. See, what happened in 2021 was was a time when the funding was available at large for companies which may or may not have reached to certain milestones, but have got a higher amount of funding than where the companies were, right? And founders are the smartest of the ecosystem members, right? And we're always trying to understand the current nuances of the market and try and do best for the company to grow, company to grow fast. And in the process, you had to sort of invest very heavily, even knowingly that there could be some levels of inefficiencies there, right? Whether it's on the R&D side, engineering side, and on the marketing side, and on all the fronts. One, because there was sort of resources available. Second, the adoption by the larger companies on the tech side was potentially try and try and leverage that and grow fast. And then one of the elements that you highlighted where the hiring talent was extremely difficult. So you're saying, okay, look, then I might as well over invest a little bit to try and see that even if there is a few employees leaving, it doesn't really impact the path, because going towards a certain path and achieving the growth was of paramount importance. Now that has changed. That has changed significantly, even for the public markets and for the private companies. And of course, there will be certain companies which probably would be at a stage where there is a larger amount of cash flow pressure. There could be a lot more drastic corrections, right, that one needs to take. But by and large, because we're seeing SaaS companies are a set of companies where inherently business model involves recurring revenues, right? Where you're essentially, your next months and the months after revenue is not really dependent on your this month's spend, right? Because you have these contracted revenues. In the current market, what's becoming really paramount important, if you really look at it, right? Essentially, you're saying, look, first and foremost, let's figure out ways to safeguard that current revenues, which essentially means that you don't want customers to churn in spite of the customers' budget pressures and all of that. So there is an increased amount of activity very clearly on the customer success front to try and sort of ensure that your existing customers are sort of really well placed. And then you're also trying to figure the most easiest ways to try and sort of grow the revenues incrementally is to say, okay, how can I increase the current existing revenues, existing customers' revenues by expansion era? So there's a lot more emphasis on the expansion era. And then you're saying, okay, look, on the marketing and the sales side, how can we sort of find the most efficient ways of growing? And a lot of the emphasis being sort of spent on, built on the North Star metrics as to how we drive that efficiency in the sales team. And by when some of these founders in the survey have said that, look, I'm looking at allocating resources to the marketing and sales teams. One of the questions was, isn't that counterintuitive? Because you're essentially saying that you're increasing the burn. Not really. What we're seeing is that there is a clear effort to channelize the resources in the most impactful sort of way. Where when you look at the current markets, it becomes very important to safeguard your existing customers, figure out the ways to expand, and then try and add the newer customers, right? And newer customers in a more efficiently driven sort of marketing function, where you might have to increase the resources, but increase the resources with a lot more stringent productivity metrics. And if you pull back and you sort of say that the company needs to have higher efficiency metrics for getting better valuations and all of that, you're really referring to all of these things, and which is sort of become inherently required to be building the businesses in the current environment. And it's very heartening to see, and it's some of the the early stage entrepreneurs and the aspiring entrepreneurs who are part of the audience should note this, that there is it's not like there's a huge lag in how the entrepreneurs are operating. Already there is a inculcation of a lot of these things, which we all can learn from, depending on the stage where you are as a company, to see which are the sort of areas one is prioritizing and driving towards efficiency.
I completely agree. I think it doesn't make sense to throw people at the problem. You build the processes, you see it works, and then you scale it up. Right? That's the fundamental rule of the business. And in that construct, if you're adding more people in the sales or marketing side, it makes sense because the process works. And adding, that team should also result in that revenues. And it's sort of, the way you build a business, right? You have to invest upfront. I think the other part also, which is very interesting, and we're talking to a few founders, the ones who were focused a lot in terms of creating those repeatable, replicable, scalable processes, so to say, found this period to be very interesting because the ad spends had reduced. Fewer startups, fewer large companies also spending on digital ads, and for them, it became a lot more viable channel, and they were ready to invest there, right? In terms of increasing the sales and marketing costs. So it's a lot to sort of keep the fundamentals in mind, regardless of what the competition is doing, and not just follow it. I want to use the next 10, 15 minutes, Venkatesh, in terms of, looking a bit more forward as to, what are the kind of opportunities, which you feel are out there in Chirate's perspective? What are the sectors or technologies or market segments that you're really excited about? That's my one big question. Then I'll come back to you in terms of, maybe layering with some of the learnings from the recent part. But what sectors, technologies, segments interest you?
Sure. In terms of the areas that we are continue to remain excited about within the SaaS, some of those specific areas Saad has also sort of highlighted. Essentially, it falls in like 3-4 buckets. One is clearly, we think that there is a large potential for disruptive companies to come up on the DevOps side. Different elements of DevOps, and what all can be the specific subsegments and areas where we may see companies on the DevOps side are fairly wide. And if you see, one of the core reasons why we believe that can happen is that for any company which is playing on the overall sort of DevOps side, the newer approaches of driving the adoption, whether it is through the community or through the open source strategy, becomes really, really important. And when you have a sort of, 10% of the global talent pool sitting in India on the developer side, the newer, new age sort of tech talent in terms of AI, ML, almost being the largest in the world, whether, you look at it from a GitHub contributor perspective or any other metrics, we do believe that apart from the other strengths that we have highlighted for the SaaS ecosystem from India to sustain, right? And those strengths will sustain. I think, on top of that, for a DevOps company, I think that even driving the initial adoption and initial sort of market success, there is an inherent advantage when you are playing in the India US sort of as a corridor. And as a result of which, we've seen some of the companies already sort of growing fast in the early stages. And of course, there is an example of companies like Postman, which is sort of driven very big, right? And I think, more and more we will see opportunities on that side. So DevOps is clearly one of the areas we feel that there is a inherent significant advantage which can be dipped into. Cybersecurity is always sort of, had a huge promise as a potential. We've seen far fewer companies than what we would sort of want to look at, but we've seen the surge in such companies in the recent past. And for the for 2023 and beyond, we think that cybersecurity can be a good potential area for us to continue to look at. Of course, there is a lot of conversations and discussions about how generative AI can potentially sort of have an impact on everything that one does. And there's a clear surge in the startups that are sort of, we are having interactions with in the recent past, coming up with different kinds of use cases that they are looking to solve with. Right. So that's an area that we're closely watching out. It's still super early. Even when I talk to our global peers, sitting in the valley, the investors there, I think there is an element of excitement, but there is also an element of saying, look, nobody is really sure, like, what all kind of companies can come out and how it can disrupt. I think the situation is reasonably similar, even from the India ecosystem perspective. And whenever I have seen such scenarios where there's a lot of uncertainty, I think that's when the standout entrepreneurs have come with a vision of looking at some use cases with a lot more clarity of thought. So we are, fairly bullish on the generative AI side. In fact, to give you an example, right, one of our companies from the from about a 2.5-year-old investment. It's done really, really well on the generative AI side. It's a company called Pixis. They are solving a use case on the marketing side. So they've created this whole AI infra, which works super automatically and caters to end-to-end functions for a marketeer. Very large US customers are adopting them in a very fast manner. They've actually grown almost about 3.5x in the last 12 months, from about $10 million to now close to $40 million. So we're seeing that kind of growth. Today, it probably is while there is a lot of talk and conversation about how generative AI companies can disrupt the future, there are very few which are already demonstrated the monetization, and probably Pixis coming from India is like the second largest globally in terms of companies which can demonstrate revenues using generative AI use cases. So we are watching that space super closely, and we'll continue to look at investing in generative AI driven models and vertical SaaS. Now, vertical SaaS being one of the focus areas for a few years now, and it's going to continue. We feel that there will be more and more adoption by typical industries which are not being at the forefront earlier, right? And I think with the advent of how the tech is evolving, it is now a lot more possible for the startups to solve specific use cases of certain verticals where the adoption by the companies can become super easy with few clicks and all of that, right? And that was what was required for some of those industries which were laggards in terms of adopting tech to make it easier for them. I think a lot of that can be done now. And so we are very closely watching out for companies on the vertical SaaS solutions. We already made few bets. The companies are growing well. So we continue to remain very bullish on that side. We also sort of are looking at the Web3 infra companies. But I think these will be really sort of some of the areas that we are very excited about.
No, I think absolutely. I think broadly, if we look at those, two parts in terms of, I think one of the important things which came out in the last 4 months was how is the total tech spend increasing? How is the IT spend increasing for large enterprise? How is the digital adoption improving post-COVID across the world? And I think last year there was a lot of concern in terms of, the whole recession slowdown topic, consequently, reduction in tech spends. And almost every major firm out there has revised their estimates in terms of what the digital spends would be, both on the product side and the services side. And they continue to be marking up by 1%, 2%. I think the latest data say that it's going to grow by about 7% year on year and expect to do so for the next couple of years. So it's safe to say the market time is in that sense increasing on one side. Number two, adoption metrics are showing increased pickup. And there is enough play both on the horizontal and the vertical side. I think vertical side many times gets underestimated in terms of complexity of a problem statement and importance of a workflow and how you built into that workflow, how you solve for the workflow, which is that. Not an easy segment, but definitely picking up steadily. We keep referring to consulting as a space where there are a bunch of things we need solutions for. Right? For example, for us, generative AI, one big area is knowledge management. We just have an insane number of slides. We are in favor for reusing it, but people don't know how difficult it is to find the right slide.
Sure.
But I think it's a fairly open space, which is there. The one point I want to go back to, and this might be a bit cautionary in terms of question, right? So, for example, Web3, or I'll start with crypto, right? And then we started calling it correctly in terms of Web3. And now we have Gen AI, right? If you see, all three of them went to that whole hype cycle that everybody was building something, from a decentralized perspective, and now from a Gen AI perspective. In terms of these previous spikes that we have seen, which have not necessarily always translated into large business adoption, I think we have good companies. For example, Polygon is doing really well, but there's still exceptions, right? So when an entrepreneur thinks of Gen AI, because somewhere in their mind it would be of solving for the investor in terms of making it very, very high tech. No offense here, but is there something you would caution them against, or you would ask, you would advise them to ask themselves as a question and not get carried away with the bandwagon, so to say?
Yeah. See, there is an element of truth to that for sure. I think there is an element of hype already built in the Gen AI side, right? And a lot of the times I hate these prescriptionary questions, right? Where essentially you're saying, okay, what should the entrepreneur do? I actually feel that there's a lot of the smart entrepreneurs are already sort of figuring out how do we. If you look at the most recent earning calls of large public companies, the Fortune 500 companies globally, I think I read a statistic which says that some 55 or 58% of the CEOs during their earning calls have referred to how they are looking at adopting Gen AI. Now, if you think about it from an entrepreneur perspective, irrespective of what the investor is saying, this is an opportunity to showcase how your product is leveraging the faster AI cycles that can now be implemented with the Gen AI and make your product fit into that category, which can increase your business. So that's a very smart thing to do. It's not a hype. Okay, there might be an element of hype to the overall sort of how the sentiments are getting driven. But if that is going to help you build the business, of course, there'll be investors who want to come and invest in your company. So there is an element of market reality of what your potential end customer will want. And hence, there is a absolute strong reason for you to, like, for example, I'll talk about one of our portfolio companies. which is in the incident orchestration space for site reliability, SRE focused companies, right? And they today have like 400 plus customers who adopted the platform over the last few years. So there's an high element of data, and there has been efforts to use that data to create, to sort of drive the AI and the learning models in a way where you're not only sort of orchestrating the incidents, but you're also sort of thinking about how do we do the response creation in a much more learned way, right? Where you can automate that part. Now with the Gen AI and the current sort of trends, where it does become a lot more easier for you to drive the AI innovative models and bring it to the production levels much faster. Now you can stand out as a company where you offer that in your solution versus the existing players, and make that as a reason for your end customer who's also now thinking about adopting more and more vendors who are talking about Gen AI and how that is augmenting their existing offering, right? So I understand there is an element of hype, but I also feel there is a market reality, and there is a strong fundamental reason to drive and utilize the current sort of AI becoming more and more faster to innovate those cycles to augment your solutions and platform and stand out from the competitors to win. Which essentially means the innovation cycles will become a lot more faster, and hence, there is an opportunity as a company for you to stand out, but there's also a risk that one may lose out if you're not innovating faster. So I think there is and you can already see that from the founder survey that there is an element of that the founders are already talking about. So I think that's how we view the current sort of the whole Gen AI chat.
No, got it. Part of the job is to ask the questions, which are not always popular. But no, I think completely agree with you. There's a fair bit of opportunity. There are enough problems to solve across the world, right? And in that sense, we have a lot to do. I won't take too much of your time. I'll push it back to Stuti. Thank you so much, Venkatesh, for that conversation. And of course, once again, thank you so much for all the help that you and the team have put into the building that report.
Thanks, Adit.
Thank you so much, Venkatesh. Thank you, Atit, for this engaging and thought-provoking conversation about how companies can navigate the current market conditions and where does the opportunity lies for Indian SaaS. Now moving on, we'll now be taking up some questions from the audience. So you both have already covered few of those in the fireside chat, but I request you guys to please stay back and also invite Saad for the Q&A. We have gotten a lot of questions from the attendees. Thank you so much for showing such active interest. I'll direct these questions to our panelists. However, in the interest of time, I request all the panelists to be crisp in their responses so that we can take up as many questions as possible. So so I'll start now. So a lot of talk about valuations, right? So one of the common questions that we have been seeing is, how are these valuation multiples different for early seed and late startup, and what is the reason for that? Venkatesh, would you like to answer it, please?
Sure. No, so the multiples that we're referring to are largely the multiples of either the public listed companies or the late stage sort of private companies, right? Mm-hmm. On the seed side and the early stage side, it becomes extremely difficult to, given the nascent stage of the revenues, to be actually measuring the EV for a company which is potentially has just first few customers and is at a 50K ARR. You're not really sort of potentially talking about a 10 times multiple of that, et cetera, right? Most of these funding rounds will be keeping in mind that you're actually funding the companies without sort of, overly diluting the founders, right? So I think as a result of which the revenue multiples at the super early stages like seed and early will always look higher when you look at it from a pure metrics perspective. But they're not going to be like really comparable to a late stage or a public company. Having said that, what I do want to highlight that in line with how the sentiments on the public market valuations in the late stage growth multiples have come down, there is definite correction even on the early stage side, and almost 2/3 the valuations have decreased. But you can't really counter it with an average EV revenue multiple, if that answers the question.
Yeah, that was great. Thank you so much. Now, there's a question going back to the revenue figures mentioned in the report. So I would like you to take it. So there's an expected drop in the growth rate of SaaS revenues that we see for the next 4 or 5 years as compared to what was there in the last 2 years. So can this be attributed to only the macroeconomic environment, or are there any other major factors affecting the revenues?
Yeah, actually, I mean, first of all, if you look at the revenues, the growth which happened in the last 2 years, that growth itself was first more like an outlier growth, because that was the pandemic period where we saw a significant increase in terms of digital adoption, digital transformation, digital budgets going up for large companies and enterprises, even SMBs, suddenly adopting this, right? So there was a significant growth in the last couple of years, which was more like an outlier growth. What we're seeing right now from now until 2023 is a more rationalized kind of growth, right? And how we've gone about doing this is we've evaluated companies across different ARR buckets, understood them as well, understood how have customer acquisition costs really impacted revenue generation capabilities. We've also factored in some of the elements around, technology shifts, significant disruptions that can really change the way the market really moves, right? So currently, based on what we understand, this is what we are projecting. Some things like Gen AI, for example, right, could really be explosive in that sense. So what we are projecting, it could also be, possibly a little higher than that. But that really is to see how it pans out, over the next couple of years, especially, right? Maybe the next year is quite critical in terms of how that really goes up. But yeah, so we factor in multiple things, not just looking at it from, okay, how was it before and now what is the drop over here? The drop earlier was mainly accelerated because of the pandemic. Now it's more a rationalized kind of growth. Hope that answers the question.
Thank you so much, Saad. Now moving on, so there were quite a few questions about the opportunity areas that you guys dived in detail in the fireside chat as well. So we've covered, I think, DevOps, Gen AI, and even vertical SaaS to some extent. But why is cybersecurity a hot market? Like, what are investors or say founders looking at it in this space? Any one of you can take it, please.
Ganesh, should you want to go first?
Yeah, sure. Yeah, cybersecurity is one area where, if you see historically, I think even in the global markets, you always see advent of newer startups coming in and sort of disrupting, even without the current hype on the Gen AI and the AI side, right? I think you've always seen historically over the last sort of even 8 to 10 years, newer and newer companies emerge with differentiated approaches on how the security can be provided, how threat mapping can be done, how your workload protections can be driven, et cetera, right? So I think as a result of which, for investors, you always sort of felt very positive about how, funding the newer startups. There's also an element of very strong consolidation in M&A-driven market. If you look at the M&As globally, right, I think cybersecurity really stands out, and which also means value creation for everybody around, including the founder and the investor. And with the advent of AI, I think we also see more and more companies are, there is a potential to come and disrupt the existing ways of driving the security. Even the security market in the recent past, like if you look at the CISOs who take decisions on purchase of security solutions, the way one is looking at and evaluating companies and adopting the initial sort of set of companies also transformed a lot in the last few years compared to how it has traditionally happened, where there was a lot of enterprisey way of adopting the solutions. where you go through a large period of evaluation, a long period of evaluation, sort of engaging with the companies, etc., which has now shifted to lot more sort of, community way and the open source way of testing out the companies and testing out the newer solutions, which clearly also means that there will be a lot of opportunities for the startups to come to the forefront of the CISOs in a much faster way and in a disruptive way. As a culmination of all these reasons, we feel that cybersecurity will continue to remain as one of the key areas for us to look at.
Thank you. Yeah, Atit.
I think completely to Venkatesh's point, security, to take a step back, security as a business has always grown over the years as more people have come onto the world, so to say. And it's one of the segments which has never seen degrowth. It's always seen a growth for a multitude of reasons. I think what happens in the cyber first world is that when you layer it with the need for regulations, when you layer it with need for, say, the consumer protections, when you layer it with the need in terms of data is oil, or in terms of, AI will end up, use this data to create interventions, and then you want it to be responsible AI. The risk is too high in terms of something going wrong, which is then that sort of fundamentally sets up cybersecurity, as a core segment, and it's a business which is constantly evolving, because the one that you're protecting yourself from is also evolving. So a lot of fundamentals back cybersecurity as a segment or as an industry. The fact that it's constantly evolving, really makes it very, very interesting. And then to Venkatesh's point, you have this whole element of M&A and exits also happening continuously.
Cool. Thank you
just
so
to
much.
add a layer to that as well, just, in terms of just numbers itself, the estimated cost of cybercrime itself is increasing significantly, right? That's just in terms of a driver demand for it. And they're estimating globally it's going to be about 10.5 trillion by 2025 alone, right? And we've seen a lot of, and as a result, we've seen a lot of global funding also in this space, right? Almost 18 billion in terms of global funding in 2022 alone. So yeah, just adding those couple of points there.
Cool. Thank you so much, everyone. Just one last question we'll be taking. So adding to the whole resiliency and efficiency themes that were talked about throughout the session. So today there are customers asking for performance indicators much higher than the web scale providers. So what could be a generic guideline to mitigate these and keep the cost at bay? Venkatesh, would you like to take it?
Sure, Stuti. I think, we've actually been seeing that for quite some time now, like almost for the last 3-4 quarters. And that's where there's a more and more emphasis, even from the founder side, to invest on the customer success side, to ensure that the value is being seen by different customers. Based on the use cases, there could be different ways and strategies in how you can demonstrate that value to the user, right? And there could be some companies where there's a lot of AI or the backend magic happening, where it's not like, there's a workflow which you're continuously using and there's the dashboards that you can refer to. And then becomes a lot more important for such companies to be extremely proactive, without which in the current market, we definitely are seeing customers coming back and asking, saying, for the proof of that value creation, because there is also continuous pressure on the end customer side to decrease the budgets and sort of relocate it, the contracts to negotiate the price down. And which is where, if you see, one of the first things that the report highlights as taking is also sort of giving a lot of priority, importance, and increase our resources on the customer success.
Yeah, and I think one of the examples that Venkatesh took was of Pixis. One thing which is very clear as soon as you land on the website is the value it creates. So that articulation of what is the value in the language that the customer understands is going to be of paramount importance, because the software buying in itself is getting more and more sophisticated now. The buyers are a lot more experienced. They're a lot more aware of what's happening. There are a lot more tools to help them figure out what other solutions can come in. So what we are at the core dealing with is a very sophisticated buyer, and it's only going to become more and more, stronger as we go along. So value articulation remains fundamental to the business.
I would like to thank, Chiratae Ventures and the partnership that we have with them in building out the thought leadership on the ecosystem. Specifically, I would like to thank Venkatesh, Tarang for their continued support, inputs, and feedback in our journey in building out this report. I would also like to thank all the founders, investors, experts that we spoke to while we were doing this entire study. Thank you for the audience for tuning in and joining in today. Do send in your questions. Before I close, in case you have any queries regarding the report or on the subject as a whole, please feel to reach out to us. You can reach out to prashant@zinnov.com. His email is in the chat window. So thanks a lot, everyone, once again, and have a great day ahead. Thanks.